Welcome back to another week of What the F Happened. We've got TikTok, Instagram, YouTube, Facebook. We got all of you. And today we are going to talk about why most of you suck at investing money. We're going to talk about why all of you treat investing emotionally. You don't go at it with a strategy. You don't go at it with rules. You don't go at it with anything other than emotions. And we're going to show you how history proves that I'm right about this. And we're going to show you how the best performing fund manager of all time, how he did 29, almost 30% returns, and most investors lost money. How can that be? If somebody makes 29% by investing in the best fund manager's fund, how can most investors lose money? That's what we're going to hit today. We're going to show you what you're doing wrong, how you can fix it, and how you can course correct by looking through a different lens when you're looking at investing. We'll be right back to What the F Happened. All right, we are back for What the F Happened. Many of you know what this is. This is a show where we rant, we rave, and we argue about topics all related to the market, to economy, and to freaking money. Steven, my co-host and my partner in crime, is right here with us. Steven, what's happening over there in Florida?
Hey, good morning. Florida's good. We had a wonderful 80-degree Christmas holiday and wouldn't expect anything less. So it's been a fun week. I hope everybody had a Merry Christmas, Happy Holiday, and ready for New Year's. But today I'm excited. We're going to dig into why people use emotion to drive their investment decisions instead of just following their strategy. And Warren Buffett really said it best: buy low, sell high, and don't lose money. So why can't people follow those simple directions, Chris? But we'll get into that today. And then we'll talk a little bit about how crypto's continuing its crazy roller coaster ride over the holidays. It had its little Santa boost up to, 53, 55,000. It's right back down on its way back down to 45,000. Many people said by 2022, we were going to hit six-figure Bitcoin. We're not there. What happened with that? We'll get into that. One thing I know we don't want to talk about today, though, is freaking COVID and Omicron. F that. We're done with it. We're done talking about it. We're sticking with money, right, Chris?
That's right. So if any of you are here to talk about COVID, then go somewhere effing else, because this isn't what we're going to talk about today. This is our last episode of the 2021 year, and we are going to get right to the point and how you can make some motherfucking money, because that's all that matters, because you're all fucking it up and you're going to lose it all if you don't pay attention and you don't start taking some different actions with your investment strategy and investing through a different lens. You're going to end up just like all the people we're about to talk about. And I can't handle that, folks. I want all of you to make money. I want you to not just make money, but keep money. And that's the biggest thing here. You see, we got to start investing smart, not emotionally. All of you, and I'm sorry to lump all of you in, but literally statistics show it's over 95% of you. So that is all of you for the most part. Only 5% of you got this shit figured out. We got to start investing smart, because if you keep investing emotionally, if you keep chasing the FOMO, the fear of missing out, if you keep chasing the winners, you will be the loser. Statistically and historically, I will prove it to you. I don't care how far back you want to go. Heck, you want to go back? I got it right here. The global stock market history, folks. There you go. TikTok, Instagram, and everybody else. Since 1531, how far do you want to go back? Because I'll show you that no matter how far we go, even if we go back to before Christ, the same laws of wealth apply, and everybody, for some reason, has forgotten these simple laws of wealth. So, Stephen, where can we get started? I want to talk about stock market returns and the everyday investor. What do we have an article for that?
Yeah, I mean, so where I wanted to start today is just, let's just talk real briefly about, what is an average stock market return? What do we mean when we talk about the stock market? Because, Chris, you can explain this, but, the stock market's comprised of, I don't know how many companies, thousands?
Absolutely. Thousands
Tens
and
of
thousands of different companies.
But when you hear, like, when you talk about like average stock market returns, they're not talking about every single stock in the entire stock market, you know, in the United States and there's multiple stock markets. There's the New York Exchange, the Chicago Exchange, right? So, but when we talk about the stock market, we usually talk about what's called the Dow Jones Industrial Average and the S&P 500. So just to kind of set that up for you, that's what we're talking about. And, you know, the average stock market return, historically speaking, is 10% annually before inflation. So stock market returns vary greatly, however. So what we're talking about is, you know, when we look at, you know, the last 100 years or so, the historical average of the S&P 500 is about 10%. But that doesn't mean that investors are consistently making 10%. And that doesn't keep in mind things like inflation, you know, typically 2 to 3% inflation. And right now we're at what, 6.8%, they say, right? So it's not taking that stuff into account as well. Good.
Yeah. So, you know, with this, and you've got this stuff on here, and I'm showing TikTok what we're talking about. We're talking about the historical average stock market return is 10%. But the problem is the average investor does not make 10%. And why is that? If the stock market averages 10%, why is the average investor not making 10%? Well, it's very simple to understand. You're not investing properly. You're buying high. You're chasing the best performer. You're not doing what professional investors doing. You're not investing with a set of laws, a set of rules. That's it. Every professional investor, from hedge fund managers to mutual fund managers to ETF managers, outside of ETFs because they're more passive, but every one of them has rules that they follow for investing. They have target buys. They have target sells. So imagine that. When you buy an investment, you actually know the price at which you're going to sell. And when it hits that price, you fucking sell it, because that's the rule. Too many people buy something and then it goes past their target. Oh, I would love to make 30% return. Great. Then write it down, create your rules. And once you got your rules, when it makes 30%, you gotta sell, because it's all about buying low, selling high. And if you just do that, Warren Buffett says at best, you won't lose money. So let me ask you a question. Whether it's your 401k, your IRA, your any investments, your brokerage accounts, your crypto accounts, why is it that you buy, but you have no target or no rule that you are following to sell? Be honest with all of you. I want some comments coming in here. How many of you actually buy an investment and you have a target of where you want to sell that investment? And then when it hits that target, how many of you actually sell it? Now, I know, Stephen, here's the thing, and we're going to pull that article back up. Here's the thing that all of you do. I'm going to read it because this is right from the article. Now, it all makes sense. You know, the stock market returns are averaging 10%. So if I just buy and hold the long haul, then how can I lose, right? Let's just let it ride. Well, Stephen, let's show them what that actually looks like, because if you do that strategy, most of you, not saying all of you, most of you will not let it ride, because emotion will come in. So,
and there's also more on top of that too that we're going to get into right now, because we really want to get in depth with this, right? So, you know, just to show you this one last time, the graph below. So if you look at this graph right here, can you guys see that? Shows the current value of the S&P 500 as well as its year to date 5-year and 10-year returns. Between 1990 and today, you can see there have been up years and down years, but over this 30-year period, those fluctuations have averaged out as a positive return. But why do so many people start making money? But the point that I want to hone in on here is average versus actual rates of return, and so important to understand the differences. So I want to get into that a little bit, Chris.
All right. So do you want me to actually just draw it? Because that's probably the easiest way for me to show you. How many of you really, truly understand the difference between an actual return and an average return? Because how many of you have read a prospectus or looked at a investment flyer? You know, maybe it's from Fidelity or Vanguard, and it always shows the average rate of return. Can any of you actually tell me what the average rate of return really means? Stephen, pull that article back up and read that while I get this screen set up. Now, for some of you on here, it's going to be a little far. I'm going to spin TikTok around so you guys can see this once I draw it. But, you know, if you guys can't see this, we're going to zoom in on this in a bit. I'm going to have Andrew come in and he's going to zoom the camera in. So those of you on TikTok, or I'm sorry, those of you on YouTube and also Facebook will be able to see this. Let me get you guys all situated here so that everybody can see what I'm about to draw here for you. So we got Instagram. Whoop. There goes Instagram. Sorry about that. Stephen, pull that article up while I
So while you're getting into that and pulling that up, Chris, this is a great article I found on the Money Advantage, and it was just talking about how the average isn't real when it comes to rate of return. The real rate of return is objective, rational, and substantial. It delineates the exact performance of your capital from start point to end point. It has actual value and meaning. Like concrete beneath your feet, it's solid ground. At its core, it is the truth. But finding the truth is often much harder than it appears. Searching for the real rate of return can be like battling optical illusions of smoke and mirrors. Fund managers, the media, and Wall Street proclaim average rates. Everyday average yields are cited as some kind of absolute predictive authority, assuming the clout that they have no right to take. You need truth in your financial decision making. Instead of staking your financial future on the shifting sand of average returns, it's time you recognize them for the imposter they are. And
hold that thought, Stephen, because we got some TikTokers coming in who obviously are much smarter than we are. So, I never try to miss an opportunity to do a little bit of arguing here. So music_man08 on TikTok says, if you don't understand that the Fed controls Wall Street, stop talking about the market. Now, I don't know if he's actually being, negative in this, because he's absolutely correct. The Fed, and we're going to cover this in today's show. So Music Man, thanks. You're getting a little ahead of us, but I figured I'd take this opportunity because, hey, if you think you're smarter than we are in regards to what the markets are doing, then, hey, let's battle this out, man. I got the boxing gloves right over here. Let's put them on and go, because I totally understand that with the Fed right now, I will tell you, under modern monetary theory, the new economic theory that they're using, which is complete bullshit, the printing press is running at full steam ahead. Printing money, pumping unnecessary money into the markets, violating what really should be happening, which is Austrian economics. The markets should be left to their own will to go up and to go down, the normal boom and bust cycle, but we haven't done that in so long that we have forgotten what Austrian economics actually are. The only ones who subscribe to Austrian economics are some economists, and guess who? Giant mutually owned insurance companies. They still believe in Austrian economics. Now, who's smarter? The banks in Wall Street or giant mutually owned insurance companies? I'll let you guys figure that out. But with this crazy printing, when they print all this money, where does the money go? Well, I don't know about any of you, but where you're did you ever figure it out? Take the amount of people living in the United States, divide that, the total number of population, you can just Google it, divide that into the total amount of money that they printed. And then let me know how much each of you should have received a check for, but you didn't. You got a couple grand in stimulus money. Maybe you got PPA or PPP loans, or maybe you got EDIL loans, which both in most cases need to be paid back, maybe not PPPs. Where does all that money go? It goes into the economy. Most of it lands in the banks. Some of it goes to prop up Wall Street through bond buying programs, stimulating an artificial speculative market, just like Music Man here is talking about. And I don't know where his post went, because obviously I've struck a nerve. So lots of people. Oh, Taiwan Freedom said Bidenflation. I love it. Yeah, you're darn right.
Yeah, we're gonna get into what the Fed's doing with quantitative easing and everything like that, because it absolutely is driving the markets, and it's creating this crazy bubble. I mean, it's an unnatural stock market pattern that we've created, and it's creating a gigantic bubble, and that's kind of one of the reasons we're doing today's show, is just to show you that you can't listen to these average rates of return. You can't look at historical data because of everything that's happening right now. All that stuff's thrown out the window. And when this thing pops, it's going to be bad, and you need to be prepared and ready for it.
Shoot, Andrew, you here? Yeah, my camera is just not focused. So let me do something here.
Yeah, we can't really see it. So while you guys are working on that, Chris, I'm going to go ahead and get into this a little bit.
So I have a camera person, but of course they're never here when the show's going on. Imagine that shit. But anyway, we've got another person on TikTok who says, oh, look, another internet scammer. You know what? Go fuck yourself. Have any of you paid for this knowledge? Have any of you paid to come check this show out? So where's the scam, asshole? Go somewhere else, you damn hater. But you know what? I love my haters. I got a hug for each and every hater, because all haters need hugs. But let's get back to it, because I'm sick of people calling this scam when you didn't pay to be here. Let's see. Let's get into this. So here's the average rate of return. Let's just say somebody starts and they invest $100. Okay, you got $100 that you're going to invest. Now, let's just assume that we make 100% return. Okay, whoever you invested with or whatever you invested in, you made 100% return. That would mean you got $200. That's a good day in the office, right? How many of you and how many of you would be psyched about 100% return on your money? Give me an I or an AY. Come on, tell me how many of you would be excited for 100% return. Okay, so let's go to the next year. We start the next year with $200. You're super excited. But the next year, you lose 50%, or your advisor loses 50%. How much do you have left? $100 by the math. So now are you super excited? You started with 100, you made 100%, but then you lost 50%. Now you've only got $100. You're probably not so excited because everybody in a second ago was saying because you were excited about 100, but now the next year you only lost 50%, but you're back to where you started. But that's okay because the third year we start with $100, and whatever you invest in or whatever your advisor puts you in, you make 100%. So now we got $200. Whew. Man, I thought it was going to be a bad year. I'm so glad that my advisor, or I'm so glad that the investments I chose now bounce back. So I've got my $200 back. I'm psyched. Okay. So now we start the fourth year with $200. Okay. And that year, all you lose is 50%. So you're thinking to yourself, you know what? I made 100% last year, but I only lost 50. No big deal. But then you look at your statement, and your statement shows the real math, which means you have $100. So let me ask you a question. This is a 4-year run. Over 4 years, you invested 100, you made 100%, then you lost 50, then you made 100, then you lost 50. How much do you have left? 100. How much did you make? 0. Actually, you made a lot less than 0 because you still had to pay taxes on the gains. When you made this return here, you had to pay tax on that. Each time you made it, you were taxed if it's a taxed account. Now, if it's a tax deferred or tax-free account, discount that. But how many of you know what the real average return is for this investment right here? If you guys do the math, you will find that this investment had an average return of 25% by the math. Okay, so that your average return on this is 25%. How many of you are excited that you started with 100 and you have 100 left minus whatever taxes and whatever fees you paid for buying and selling or for the management fee? You don't have 100 left, you have less. You lost 4 years of your life, okay? And 4 years of opportunities that you could have done. But by the numbers and if you look at the fact sheets, the average return you just received was 25%. That's the average return. If we look at the actual return, Stephen, pull that article back up.
It can even get even worse. Like if you start this process in a down year, I mean, look at this. So people tell you, hey, you're going to make 10% average returns in the markets. So what you're expecting is this chart right here. You put 100 grand in, and if you do the math, after 4 years, you're up to $146,000. That's 10% a year. That's averaging it out. That's what you would expect, right? But let's take a look at what really happens. So in the first year, if you get a negative return, which happens all the time, where the negative, it has a 10, 20, 30% negative year in the S&P or the Dow. So right here, we have a 20% down year, a 20% up, a 60% down, and then 100% up. But at the end of this same $100,000 initial balance, it makes it look like we're averaging 10% with these returns, but our real return, our $100,000 dropped to $76,000. We actually got a negative 23% return. So it just goes to show you how average versus real returns can differ so much, and why advisors and people love to talk about average returns.
So that's an average versus an actual return. It's just insane. You're absolutely correct, Josh. Right there, he just made a comment. The trolls are out to learn something new. You know what they're out to learn? How to hate and not learn. That's what they're out to learn. All right, what do we got next? Because I got some good shit. We did average versus actual. Let's talk about the real world. Peter Lynch.
Yeah, let's stick with the people that want to learn.
Yeah, I'm sorry. I just, hey, listen, I every morning, I have my coffee and I just got a little anger in me and I just got to get it out. And, all right, I'm done.
All right, so this is an article that was put out a few months back by Forbes that's talking about one of the top fund investors, fund managers, Peter Lynch, of all time. So this is titled How Investors Are Costing Themselves Money. So Peter Lynch, who formerly managed the high-flying Fidelity Magellan Fund from 1977 to 1990, is a legendary investor. Under his management, the fund averaged an astounding annual return of 29%. It would seem all you had to do was ride along with Lynch and you would earn phenomenal returns. But that did not happen. According to Fidelity Investments, the average Magellan Fund investor lost money during Lynch's tenure there. How does that happen? That may be an extreme example of what plagues individual investors, but it is highly illustrative of investors' behavioral challenges. According to Dalbar's 2021 investor behavior study, the average equity fund investor underperformed the stock market as represented by the S&P 500 by nearly 1.5% over 20 years through 2020. The annualized S&P 500 return during that time was 7.43%, while the average equity fund investor earned 5.96%. That is a significant performance gap that could be costing investors their financial future. What's behind the gap, and what can investors do to overcome it?
Yeah, I mean, and it really just comes down to that emotional thing. And, there's a book that I'm reading right now, Beyond Millions. It's a CFP that we work with. And he's talking about this, with Peter Lynch. Peter Lynch was a great fund manager, and if any of you follow the Fidelity Magellan Fund, it's a fund that we highly recommended when I was a broker and an advisor. We put it in almost every 401k. It was in almost everything. It was just the best performer. But the problem is not that Peter Lynch did anything wrong, not that Fidelity did anything wrong. It's right in what Fidelity Investment says. They said that the average investor in the Magellan Fund lost money during his tenure doing this fund. Why? How is that even possible? Well, like Stephen just said, it's very possible. If all you do is you look at a fund and every year the fund is up, you invest your money. And then if the next year Peter didn't have a good year, because he did this from 77 to 1990 until they eventually closed the Magellan Fund because it just got too big. But if he did those returns and you only invested when he was doing well because it felt good, because you thought you were missing out. Oh my God, he's at 25%. I got to get in. But then the next year, let's just say he only made 4%. Okay, and that happens. Fund managers can't get it right every year. So you only made 4. Maybe you lost 10 because of, just general market environment. Maybe the government, controlled the market like all of you on TikTok are saying, and I agree. But the whole point is if all you did is invest when it felt good to invest, and then when it didn't feel good and you got scared and fear kicked in and you sold, or you moved it to a different fund in your 401k because you're like, oh my God, I'm down 10%. I gotta find the next best performer. And you look through the list and you just find the one with the highest return or highest average return for any time period, and you move your money there. You are literally doing it backwards, folks. Truly, you are making some of the biggest investment mistakes, which is why Fidelity says that. Like, one of the best performing funds of all time, one of the best managers by some account of, mutual funds, and most people lost money. Doesn't make any freaking sense. But it makes all the sense in the world if all you do is chase the big returns. You should be really doing your due diligence, investing in things that you know, like, and understand. And if you know, like, and understand in industry, let's just say your industry is technology, and you've done your research on technology companies, you really understand these tech companies, then invest in tech companies and do your due diligence. Read the prospectus. How many of you have actually read a prospectus to know what you're investing in? Most of you don't even know what the fees are in the investments you're in. You just invest because it has a big number, which I already showed you what that average return is. These are the mistakes people make. And listen, folks, this isn't my opinion. You just saw the article. This is Fidelity Investments. They've been around a little while. They're telling you this. So that's the problem. The problem is this: you need to start following the laws of wealth. The first thing, I had somebody on TikTok comment, I'm 59, I haven't really done much investing. Where do I start? And I have a 21-year-old here, and I love this. WAACCKKK, weird name, but he's 21 and he's asking what to do. Now, that is a really smart 21-year-old. Because most 21-year-olds aren't even thinking about this. Most 21-year-olds aren't even up yet watching a show like this. So I commend you for asking that question. What should you do? Well, the law number one, the first law when it comes to the laws of wealth. And here, Stephen, let's give some stuff away. You want to do that? I'm going to give away this book right here, The Richest Man in Babylon. If you haven't read this book, it's a must read. It's not very big. It's a very easy read. There you go. Richest Man in Babylon. I'm going to give this away. And we're going to, Stephen, think of a question we can ask to give this away. And I'll give away 4 of them today. Okay. And we'll ship them to your door as long as you're in the US. If you're not in the US, maybe we'll send you the audiobook of it. But here's the thing. The first law of wealth, it's going to be in my new book, and it's also in The Richest Man in Babylon, is anyone who wants to build wealth has to keep at least 1/10 of the money that they earn. In other words, when you get your paycheck or when you look at your yearly income, your total income, you need to be keeping 1/10 of that. And most of you are thinking, wait a second, I keep it all. I worked for that money. I earned that money. No. Keep is the same as save. I just don't like the word save. When you make your money, and you put it in your bank, which is the first mistake most people make. They put it into somebody else's bank. And then after that, you spend that money. You have bills, you have car payments, you have credit cards, you have lines of credit that you pay. That's money that you don't keep. That's money that you give away to somebody else. You're losing that money. It is not staying in your family. So you need to learn how to keep at least 1/10 of your gross income. So if you're not doing that, that's law number 1. You can't do law number 2, 3, 4, 5, 6 until you get law number 1 down, because how can you build wealth? How can you get ahead if everything you make, you give away? You know, people are always saying, I live paycheck to paycheck. Like, I'm doomed. You're not doomed at all. Do you know how many people Stephen and I know and that we talk to? We talk to thousands of people. We have thousands, I think it's over 4,200 clients. And out of all of them, they had to follow law number 1 before we could ever help them. You know, I love talking about Dave Ramsey. We love Dave Ramsey, but Dave Ramsey helps somebody that we can't help. He takes you from paycheck to paycheck, helps you climb out of debt through the envelope and the snowball strategy, which is a sound strategy. And then once you're ready and you're saving money because you're not giving it all away, now you're ready for us to help you. And then you're ready for somebody else to help. But that's the first law. So if you're 21 or 59, like, let's start there. Let's start with keeping that.
I just want to add, you know, paycheck to paycheck is not a money, it's not an income issue, right? Because I'll speak to somebody that makes a couple $100,000 a year, but guess what? They're living paycheck to paycheck themselves, because it seems the more you make, the more you spend in life, especially when you're trying to keep up with the Joneses and things like that. Now, I don't want to say you need to cut back on going to Starbucks and you need to save all your little pennies and things like that, but learn a way to make more money. Maybe find a way to an investment strategy, things like that. So it's not an income issue. It's just an overall financial strategy issue a lot of times.
Yeah, you're absolutely right. And hey, what's up, Crypto Legend? You know, Crypto Legend's with us almost every week. The dude gets it. He's awesome. He said, you want to print money, turn on the money multiplier program. And I love this. This comment I got to do. It's coming in from Facebook. It's from Dexter, who we know, Dexter Holiday. What's up, bud? He said, so far, this is the best scam I've ever encountered. LOL. I've made more money with these scams than I have anything else. He's joking, folks, but he's talking about like what TikTok is saying is this is a scam. Like he's talking, Dexter's probably talking about the money multiplier method, the infinite banking concept, privatized banking, whichever you want to call it. But I mean, thanks for that comment. That you're absolutely correct. And it's awesome. I had to read it twice because at first I'm like, wait, is this another one? No.
Dexter's a rock star too.
Oh, I know he is. He's totally a rock star. And we deal with a lot of rock stars. And, you know, a lot of the rock stars do come from TikTok. You know, yes, we have our haters on TikTok, but we love our haters because they become the next people that want hugs, because they get around the campfire and they actually learn instead of hating. It's easy to hate. We live in a society that breeds haters. They want us to hate. So it's very easy. So I commend all of the haters because that's just what you want to do. But the second law of wealth. So let's just go one step further for the 21-year-old and for, you know, some of the people that really want to know, what is the second law of wealth?
Hey, Chris,
go ahead, Stephen.
Let me just reinforce what you're saying real fast and why these laws of wealth are so very important, because just hear me out for this 1 second here. Sure. You know, this is what they're saying. Investor underperformance is often a result of poor investment decisions. The great investor Benjamin Graham once said, the investor's chief problem and even his worst enemy is likely to be himself. Instead of focusing on their objectives, they often follow the herd, selling in panic during a steep market decline or buying near market tops. They try to chase performance by buying market winners, things that are leading the market. And this is what we hear us talk about all the time, right? Over and over again. You can't time the markets. You can't, be a winner. You can't pick those. It goes on to talk about how, if you were to try and time the markets, you'd have to get two perfectly positioned trades, first to sell at the peak and then to buy again at the very bottom to be able to start outpacing getting into the market on it with an investment strategy. And that's literally nearly impossible to do. So that's why having a strategy and following these laws of wealth are so very important.
Yeah. So like folks, a lot of people, and I'm seeing in the comments, TikTok, and, thank you all for your comments. I really appreciate it. Nuts to Butts said, just win the lottery. Hey, that's a strategy, but you might die very poor and miserable if that's the strategy you use. But I love the humor in that. It's pretty awesome. When people actually boil down like how you build wealth and you follow what the wealthy do, it's very simple. There's no complex thing. It's not, do I buy stocks or do I buy gold? Do I buy crypto or do I buy gold? It's not the and or. You don't have to pick. It's the strategies that you apply, the rules you follow, the laws you follow. Those are the most important things. So the second law of wealth, let's talk about this one. Here's one of the biggest things that the wealthy do different than most people. They know how to make their money work for them. So law number 2 is you got to make your money go to work for you. Now, most of you don't really understand how to do this. You've been taught your whole life, and it's no fault of your own. You've been taught to work for money. You've even put a monetary value on your hour. We've been brought up to say, oh, wow, if I could only make, back in my day, gosh, if I could only make $25 an hour. Holy cow, that job pays $50 an hour. If I could only make $50 an hour. Then if I could only make $100 an hour. Then if I could only make $1,000 an hour. All of you have been brought up to believe that you have to trade hours for dollars. And when you do that, I don't care what the dollar amount is that you put on your hour, you are putting a cap on your wealth. You are absolutely capping your wealth because we all have the same finite amount of time. We can't make more of it. So it is single-handedly, and this is what the wealthy understand and what all of you should understand too, your time, your hour doesn't have a monetary value because it's simply priceless. Because when that hour is gone, you can't get it back. So this hour that I do here, whether I'm ranting, raving, or actually teaching you something, we can't get this hour back. So we got to make the best use of it. That hour is priceless. So the wealthy understood that they're not going to put a cap on how much wealth they can make because they put a dollar value to their hour. So they applied law number 2. Remember, you got to start with law number 1. You can't do law number 2 if you don't do law number 1 first, which is save. You need to keep 1/10 of your money. Then after you keep it, and you've accumulated some money, I don't care how much money it is. Maybe it's $1,000, maybe it's 10,000, maybe it's 100,000 that you have decided that you have kept over the year or 2 years that you've been saving. Now it's time to put that money to work. Your money wants to go to work. Now, what does go to work mean? Well, it comes in a lot of shapes and sizes. If you read this book, which we're going to give away, actually here, let's give a book away right now. So I don't care if it's TikTok or Instagram. Stephen, if you can kind of watch the comments over here, the first one that gives me the right answer is, what is from this book, The Richest Man in Babylon? Or if you haven't read this book, just tell me what you think the number 1 way to make your money work for you would be. In this book, it talks about one way that these wealthy individuals from Babylon back in, I think, 903 BC, what they did with their money. Can anyone tell me what it was? So Caligal, or I don't know how to say it, but said invest. How do I transfer from the bank? From the bank to, you watch the video in the bio, invest. Whole life period, stock market, compounding, invest in properties, buy XRP, invest whole
life insurance policy.
No. What I'm asking folks, save 30%. That's awesome. If you're saving 30% compound interest, that's all good. It's all part of it. But I want to know what was the way that they moved their money. And then that led to compounding. But how did they move their money?
Loan it out?
Bought slaves, no, which, that's not actually false. That's what they did back then. But interest. But how did they earn interest? So here we go. Sergio, let me go back. Sergio, I think that's what it is. Sergio Lopez. How did they make interest? What is the way they made interest? Barter, they did all these. Gold, they have that. Yes, that's what they traded as gold. But the gold was paid to them by doing something. How did their money go to work for them? Come on, right there. Mark Perry got it. So Mark Perry over here, and let me just make sure I didn't miss anybody here. Actually, you know what? I don't know how to say this. So I'm going to give 2 books away right now because we got 2 correct answers. We got one on Instagram. So SJC TLC, I think it is. Very small. SJC TLC. If you could you DM me your address, your full name and address, because they got it right. They said loans. That's exactly what they did. To make their money go to work for them, they did loans. And Mark Perry over here, I believe he's coming in on Facebook, said they loan it out. Absolutely. Well, you know what I do with my money? First, I change where it goes first, and I put it into my bank, which is nothing more than privatized banking, which if you want to learn about that on TikTok, check the video out in the bio. On Instagram, very easy to find. And everybody else, just go to YouTube or chrisnaugle.com and you can learn that. But that's what they did. They loaned it out. So they loaned the money out and they charged an interest rate on that money. This is before Christ, folks. This is Babylon. And that is still being done today. What do banks do day in and day out? They loan money in various forms. What does Wall Street do? They loan money in the form of margin. Every brokerage account has the ability for you to get a margin account. What is a margin account? It's a loan. Folks, this is how it's always been done. It's the smartest and one of the safest ways that you can make your money work for you is by loaning it out. Now, I'm not saying all loans are safe. You have to understand that there's a lot of things you need to learn to mimic what a bank does. Number one, how about collateral? Back in the day, they always had collateral, and they talk about it in The Richest Man in Babylon. So please DM me your address. Mark Perry, I have yours. I'm actually going to right now. Sorry, yours is going to have something special on the inside. I'm going to write Mark just so I remember. And I'm going to mail this book to Mark Perry. But, that's the thing. So when you look at the wealthy and when you look at how money is moved and how they make money work for them, just look at the banks. What do the banks do every single day that you're not doing? Well, I will tell you first off, they don't put their money, the bank's money, their tier one capital, where you put your money. The banks don't deposit money in someone else's bank. The banks go out and find guaranteed investments. They're not even investments. They're guaranteed places to store their money, like U.S. Treasury bonds. Look it up, folks. Or BOLI, B-O-L-I, Google BOLI. That's where the banks put most of their tier one capital, if not all of their tier one capital. But yet, if you walked into your bank, folks, TikTok, pay attention. If you walked into your bank, I don't care if it's Bank of America, Key Bank, Citigroup, or any of those banks, walk in there and say, listen, and go to one of the wealth advisors and just say, listen, all I want is something very simple. I want you to put my money where the bank puts its money. And you will be humbled and probably pissed off because the bank will tell you they can't do that. If you ask the bank to put your money where the bank puts their tier one capital, they will tell you they can't do it. Of course they can. But there's no money in it for the bank. There's no money in it for the bank to do what the bank does with money. That's the problem. You only know what the bank wants you to know. You only know what the brokerages in Wall Street want you to know because they will only tell you where they make money and they will paint the picture that that is the best place for you to put money. Folks, when you uncover the curtain, I spent 16 years as a high-level advisor. Look it up, folks. Haters on TikTok are like, no, you didn't. Well, look it up then. Google does everything. Like, yes, I did. Okay. And while I did that, that's what I was taught to do. Sell a product. And most of the time we sold a product that had the highest fee. So we got paid the most and the brokerage got paid the most. Folks, all you got to do if you want the truth is follow the money. But what you should be doing is going the other direction and saying, if that's where everybody else is going, maybe I'm going to do the opposite and look over here. When we talk about the real world of investing, what do hedge funds do? They look for opportunities that nobody else is looking for. They go to places that nobody else is looking. I can tell you right now, one big thing that hedge funds are doing right now, amongst many other things, is hedge funds are, number one, buying up real estate. Okay, you've heard about it. You've heard about, all the hedge funds, buying up tons of neighborhoods and real estate and renting them out. But the second thing that they're doing is they buy life insurance policies. They buy, and you've seen the commercials, right? 85-year-old has a life insurance policy, says, I need the money. I don't really care much about the death benefit anymore. And they want to buy your life insurance policy because it's a hell of a return. But how many people are actually out there looking for that? Are you actually going out and finding people that are 80, 85 to buy their life insurance? Probably not. I'm not saying you ever should. I don't think that's an ethical business, but you know what? That's what they're doing because there's a lot of money there. But that's the path less chosen. That's the path less people walk. And when you start understanding what the wealthy and what the banks and what Wall Street are doing with their money, that's a good place to start. And you might say, I don't have enough money to do that. Sure you do. If you follow law number one and then law number two, you make your money move and make your money work for you. It's not very hard, folks. Not very hard at all. Like you might say, I've only got $5,000 or $10,000. Well, somebody out there needs $5,000 or $10,000. They need a loan for $5,000 or $10,000. Otherwise, banks would be out of business. So if you got $5,000 or $10,000, find somebody's problem to solve. The number one thing you all have to understand about money is the first and most important thing all of you need to do is solve a problem. But here's what people violate. Here's what most people don't do. Most people out there chasing the big returns, chasing the unrealistic returns. And if you do that, says the law number 3 in the laws of wealth, I had to look down because I get 3 and 4 screwed up. If you seek out unrealistic returns, your money will flee you. And if you invest in things you don't know and understand, your money will flee you because eventually that lack of knowledge will be your downfall. So, Stephen, do you have anything you want to say on that? I kind of went on a little bit of a tangent there, but
no, it's very important stuff for sure.
And nuts to butts said, and what if they don't pay you back? Now that is the risk, right? There's risks with all investments. Every investment, and the definition of an investment is something that contains risk. There's a little more to it. But, when you look at investments, all of them carry risk. Buying Bitcoin, that involves risk. How many of you bought Bitcoin when it was up around 69,000? Yep. You now know what the risk was there, right? You bought high and now you're down around 48 or wherever it's at right at this moment. Okay. But there's risks in all investments. So how do you mitigate the risk is really what you should be asking, nuts to butts. And you should be asking yourself, how would I minimize that risk? Well, number one, what do banks do? Well, they underwrite loans. They look for good borrowers. Well, you could do the same thing. You could look for somebody that has a decent credit score. They should tell you you can get them for free. You could look for somebody that has tangible assets that they will pledge as collateral. That's the number one way to do it. So nuts to butts, if you don't want to run the risk of them not paying you back, which might happen. Okay. I've had one investor not pay me back, but then I got the property. And when you get the property, you now have an asset that's worth more than what your loan was. It's called collateral. So what do you got here? No, do you want to share that, Stephen?
Yeah. I mean, I was just going to say, so I think the bottom line becomes, what is your strategy, right? Are you going to be somebody that's a long-term stock market investor? And I wanted to just kind of read a couple of the tips, if that's you, that Peter Lynch has for you, because I do think that that's very important. Or are you going to be more of an active trader, an active investor, and follow somebody like what Sodi does with our 10-10 trading program, or what Larry Steinhaus does with his investor schooling program, where he's making 150% annual returns? What is your investment strategy, and what are you going to follow? Or are you going to be, kind of say, I don't want to deal with the stock market, but I want to do these asset-based investments like you're talking about, with private lending, with real estate investing, with mobile home park investing, things of that nature. So what is your strategy? But if you like the idea of long-term investing into the stock market, then I just wanted to read a couple tips that Peter Lynch has for you, Chris.
Oh, these are great. Let's read them.
Yeah, so this is, so just to, we were talking about Peter Lynch a minute ago, but he was, from 77 to 1990, he grew Fidelity's under management assets from 18 million to over 14 billion as of 1990. So he might know a thing or two. And ever since then, he's been an advisor for Fidelity Advisors and written a bunch of best-selling books and things like that. But, they asked Peter Lynch over the summer this year, what do you need to become a great investor? And he simply said, in the stock market, the most important organ is the stomach. It's not the brain. One way to work, the amount of bad news you could hear is almost infinite now. So the question is, can you take that? Do you really have faith that 10 to 20 to 30 years from now, common stocks are the place to be? It's a question of what's your tolerance for pain. There will still be declines. It might be tomorrow. It might be a year from now. Who knows when it's going to happen? The question is, are you ready? And do you have the stomach for this? Most people do really well because they just hang in there. Or do they? Or do they have that emotional trading where they sell like when COVID hits and everything starts dropping like a rock? Do they sell because they're scared and then they see the bull run coming back? And do they start buying back here and they miss out on all that? And that's what causes the most average investor to actually lose money.
Yeah, and there's one other thing that you missed there that I really want to point out for Instagram and for everybody. I got TikTok looking at this. I want you to read that bold line, the big line. Despite considerable volatility around the pandemic, the stock market has been on a bull run for more than 10 years. And if any of you understand the markets or study history and patterns, the markets typically will have a bull and a bust cycle every 7 to 10 years. And we are beyond 10 years now. It is time for investors to trim their exposure to stocks. This is being said by Peter Lynch, folks. Okay. This man isn't some slouch. You might not believe what I say. You might not believe what Stephen says. You might not take us serious. It's okay. Do your research, folks, because that's what we do. Listen, like I spent 16 years in Wall Street. This is what I make a living doing, and this is what I do. I study this shit. I read more books than most of you, read in an entire year. I read them in a month, and this is how I learn. But the thing is I don't just read books just to get entertainment. I read books to get knowledge. Every book I read, I might take one or two things out of it, but I apply that knowledge. And the biggest thing I will tell all of you is if you're buying into this FOMO, this speculative market, which is being created by, like some of the TikTokers said, by the government printing and also investor confidence. If you're buying into this and thinking it's going to go to the moon, then you really need to study the Great Depression, folks. Because during the Great Depression, they said the same thing. It's going to go to the moon. This stock's going to the moon. That stock's going to the moon. I keep talking about that because I see it all over. The market isn't going to the moon. It never has and it never will. There's nothing inherently different about market patterns today than there was back during the Great Depression, except for one thing: the government's ability to print and stimulate the markets. But I will also tell you that you're all seeing the ramification of that. It's called inflation. How you all liking the prices of your fuel? How are you all liking the price of your food? How are you all liking the price of everything? Well, all of that is a direct result of the government printing money. And they intentionally do this because inflation, just so you know, is a hidden tax. And inflation is created by the government for the government, not for you. It doesn't feel good. You guys are all wanting free. Give me free money. Well, here's the cost. Fucking milk went up how much? 20 or 30%. Great. You got your free check. Now you're going to give it all back times 10, 20. You're going to 100x this shit through inflation. Folks, there is no free handout. There is no free money. If that's what you believe, this is not the show for you because you are living in a fantasy world. Keep watching Disney. Keep watching all those shows because that's where you belong. Maybe you belong in the metaverse or whatever, in a fantasy world that isn't real. But for most of you, we are in the real world. We do care about our future. We do care about our families, and we do care about our money. And we don't want to give it all back. Now, you're either going to give it back through taxes, through inflation, or through market volatility. There's a lot of headwinds that are coming at you. So be smart. Peter Lynch just said maybe now's the time to trim some of your stocks. Some of you are thinking, no, that's wrong. Okay, everybody's entitled to their own opinion, but time will tell who's right and who's wrong. But, we don't need time to tell. We can just look in the rearview mirror and look at history, and that will tell you what's going to happen. But you should never look in the rearview mirror when investing and look at past performance to dictate where that particular investment's going in the future. We need to look out the front windshield, and we need to forecast where we think an investment's going based on knowledge that we have, based on due diligence that we've done, and based on factual data and fundamentals. And if you look at fundamentals the way Warren Buffett does or Graham or any of those guys, I will tell you there is very few investments that make any fundamental sense. That's why Warren Buffett's not buying anything. The only investments Warren Buffett took was into some pharmaceutical companies. Now, why do you think that is? Well, we're not going to talk about COVID, but that might give you a small little glimpse into that. And Cynthia said, do you think in the future that AI will do all the trading and competition will be who's the best robot? I think AI already is the winner of that game because AI is already being applied in AI as artificial intelligence in investing.
There's a really good book by one of my favorite authors, Michael Lewis. He wrote a book called Flash Boys a few years back, and it's you should definitely read that if you're interested in the AI and the robots behind everyday trading right now, because it goes into that and how these trades are made on a millisecond per, millions per millisecond basis. These trades are being made, and it's basically the average investor that's going on their TD Ameritrade account is basically, several minutes behind what these computers and robots are able to do. It's a very interesting book.
It really, yeah. And all of you need to get familiar with AI. I don't know whether it's going to be good, bad, or indifferent. I mean, Elon Musk scares the living shit out of me when he talks about what AI is coming to be right now. And it's very scary. If you don't know it, then get to know it. But I just want to hit two things. Crypto Legend is talking about, feeling great about crypto, as we are too. I buy crypto. I buy Bitcoin and Ethereum, just those two. Okay. You guys can play in those shits, shit coins, but I trade in those two, but I trade with rules. So when it gets in the low 40 range, I buy and I sell around 50. The last time when it went in the 60s, I sold at about 62. I actually did hold out a little longer and I did okay. But you know what? All of you have different things. I think crypto in the form, I think Bitcoin and Ethereum have legs. I think they're going to go. But, how are you all feeling about crypto right now? Midway through the year, crypto was supposed to go over $100 and it doesn't look like we're going to hit that because there's only a couple of years left in the year. So for all of those that were saying it's going to go to the moon, it's going to get hit 80 or 100. It's most everybody that thought that. What happened? So I love crypto, but you have, and Salerno, yes, Salerno is pretty good too, whoever just said that. But, listen, you just got to pick the ones that like and understand, and Bitcoin and Ethereum are my choices. That's just the ones I know. I've learned a lot through Spencer Montgomery, who's an expert in that field, and I've just gotten good at that. So,
again, crypto's crazy though. Just to give you an example, crazy. Real fast, just since I talked to you this morning, Chris, to right now, crypto has had over a 1,400 point swing just in the last couple hours, which is over 2.5%. It's just wild, the volatility of crypto.
For the person that said, I can't remember who it was, but they were saying, that about, the risks in investing. Crypto might be one of the highest risks, maybe not the highest risk, but it's certainly the most volatile of just about any investment I've ever seen. So if you can't handle the heat in the kitchen, as somebody said, I can't handle the heat of TikTok. Sure, I can. But I'm also going to battle it out. If you can't handle the heat in the kitchen, then don't invest in crypto. It's just volatile. You have to understand.
Could you imagine if the Dow had a 2% swing? The news is off the charts. The world is ending, all this stuff. Bitcoin does it in literally a 2-hour time span. And it's like, oh, that's just crypto.
Absolutely. Yeah. People are like, oh, that's just crypto. Well, okay, well, great. Like, here it is. I mean, it's so volatile, but there's really great support and resistance levels that you can trade off of in crypto that really are very easy to trade. Now, I'm not saying that's the best strategy. It's my strategy. It's my strategy because I understand options and I understand futures and I understand the markets, and I can trade crypto the same way I trade stocks, the same way I trade everything else. It's just support and resistance. But a lot of people are buying it and holding it, and that's perfectly fine too. Somebody else said something that was fascinating, and I just want to hit this, Stephen, before we go on to that really important video that we're going to play. Let's see. How do you feel about the transfer of wealth to crypto? I think it's happening slow. Where was it here? Crap. Right here. This is from Marcus and Sachs, okay, on TikTok. Have you seen the Elliott wave guy that says we are at the end of a 300-year run and in the fifth wave? So, folks, if you guys understand the Elliott wave and you guys understand, I know exactly what he's talking about. He's absolutely correct. We are at the end of that. And if you follow the seasons, I don't mean summer. Well, they call it, spring, summer, fall, winter. The same seasons apply to just about everything in life. And we are coming into the winter season, which all these things, folks, you can call it conspiracy, call it whatever you want. It's just statistics. It's math. It's simple. All these things land to one place. I don't care what economists you listen to. I don't care if you listen to Peter Lynch. I don't care if you listen to Harry Dent. I don't care if you listen to Jim Rickards. I don't care who, Schiff, any of them. They're all saying the same damn thing. Sure, they vary opinions on should you invest in gold or treasuries or what should you do. That doesn't matter. They are all saying that the market is going to crash, and not just a little crash, folks. Not what you saw during the coronavirus, that little dip that you saw, that 32% fall or 35%, depending on what you were looking at. That was nothing, folks. We're talking about the big one, folks, okay? The big one, the next Great Depression is what they're predicting, okay? A 60+% crash in the markets. Now, listen, I don't know when that's going to happen, nor do they. You can't time the markets. You never can. You never will. Ray Dalio, one of the smartest investors of all times, tried to do that and almost lost everything. Almost lost his entire career. Don't time the market, but be smart and use logic. Everybody has fucking forgot about what logic actually is. Just be logical. Like if you know it's going to crash because everything points there, from the Elliott wave to the 10, the 45, the 90-year patterns, all of them point to one place. Down, folks, down. And all you got to do to become wealthy is fucking get some patience behind you. Stop being in a rush. Stop rushing into everything just because it sounds good or because the guy in the Uber driver said, oh my God, are you investing in this crypto? Like 10 people so far on TikTok have mentioned different shit coins to invest in. Stop doing that and just sit back and wait. Put your money in privatized banking. Put your money in U.S. treasuries. Put your money in gold. Put it somewhere safe and sit there and close your fucking eyes and wait, because the biggest opportunity of your lifetime is coming. And if you don't want to wait because you can't, then get a hold of Larry Steinhaus, because he'll show you how to trade and how to do things day in and day out with low risk. His money moves faster than a NASCAR, as he says. Like, listen, folks, you just got to learn from the people that know how to do this. But if you don't want to learn and you just want to be safe, the warning signs are up. Stephen, let's get into this video because I think this is fascinating. And this is kind of how I want to end.
Yeah. Go ahead.
No, you got the video.
Which video is it?
Let's see. It was the Doomsday Prophet has a dire warning, or maybe it was just an article.
Oh, that's that. Yeah, no. So this is so I can share this, and I just want to recap just what you're saying real fast.
Sure.
Just have patience, and make sure that you're sticking with that, and you're absolutely right. And just to reinforce that, even Peter Lynch, who again basically runs Fidelity Investors, the advisors, right? I mean, he's even saying right now that if you, over the 13 years I ran Magellan, the market went down 9 times, 10% or more. Every time it went down, the fund went down more. So I just didn't worry about it. The stock market's been a place to be over the last 10, 20, 100 years. But if you need the money in the next 1 to 2 years, or in my opinion, 3 to 5 years, you shouldn't be buying stocks. You should think about being in a money market account. He goes on to say, what should investors do when the market eventually tanks? So my point is Peter Lynch and Fidelity are starting to set people up right now for a market correction, for the market to tank, for the market to come down, for somebody like Fidelity to start talking about that, it's basically an inevitability. So if you don't listen to the people like Ray Dalio's, the Peter Lynch's, all that Chris was talking about, when the Fidelities are starting to talk about the market coming down, it might start being the thing to listen. So this is good advice right here. Lynch says you've got to look into the mirror every day and say, what am I going to do if the market goes down 10%? What do I do if it goes down 20%? Am I going to sell? Am I going to get out? If that's your answer, you should consider reducing your stock holdings today, not when it drops 10 or 20%. If you're scared to hold in the long term, if the market goes down 10, 20, 30, 40, 50%, you need to get out today. There's no way to time this thing. And this is what the article goes on to say is, depending on what your situation looks like and what your time frame is, you're not going to be able to time this thing. So you need to do it right now today. Have that strategy in place. Are you holding in long term? Are you looking for alternatives today? And is that a money market account? Is that gold? Is that crypto? Is that letting it sit in the whole life waiting for opportunities to pull up? Is that doing private lending? And one thing I wanted to mention real, Chris, is somebody put in the comments, how do you secure collateral? So if your strategy is to start using real estate, can we talk about that for just a second?
Yeah. So Mark, it's a great question. And I think a lot of people were thinking that when we talked about law number 2 about moving your money and, how they did it and how they still do it, by lending it out, but do it safe by underwriting it and also taking security. So the security instrument's easy. I mean, and yes, I lend on real estate. It's just something I understand. It's something I like. So real estate, the house, it doesn't get up and run away. It doesn't have wheels and drive away. Well, some of them do, but most of them don't have wheels and drive away. So how you do it is the same way. So Mark, I want you to think, not as an investor, but I want you to think as a consumer. When you bought your house and you went to the bank to get the mortgage, which most people do, what were 2 of the things that you had to sign when you signed that mountain of paperwork? Let me tell you, one of them was a note which spelled out the terms, the conditions, and all the things about your loan. The second was a mortgage or a deed of trust, which is the security instrument that binds the bank to that property, meaning if you stop paying them, they can take your property by foreclosing on it. Well, the same thing can happen, but in the private world of private lending, like what we do, we lend to entities only. We never, ever lend to an individual because there's Dodd-Frank rules that we have to abide by. So we lend to entities. And when we lend on a property, we are always, for me, I truly believe that you always have to protect your wealth, which is one of the laws, the third law of wealth, protect your wealth. And how you do that is just understand from the movie Talladega Nights. If you're not first, you're last. You remember Ricky Bobby? If you're not first, you're last, son. That's very true. Be first. Be in a first lien position. If you take a second lien position, just look at who you're behind. Are you behind a bank? Chances are you'll get nothing. If you're behind a hard money lender, chances are you're going to have a hard time getting nothing. Even if the equity is there, the equity might not be there tomorrow because if the market crashes, real estate comes down with it. It just takes a little time. So when you're lending, you never want to lend 100% of the deal. Okay. 70, 80, I don't know, maybe 85% max. And then secondarily, always be in first position lien. Cars. So let's say you want to lend on people buying cars. It's not a bad place to be, but just remember a car has wheels and can run away. So you want to make sure there's a way for you to track that. I mean, banks do it. They repo cars all the time. So if somebody stops paying you for the car loan you made them, the tangible asset is the car and you have a lien. Okay. Your name is on the title. You've all seen it, right? The bank's name's down there. Well, if you're the lien holder on the title, you just file it with the DMV. It's not hard to be the lien holder, so they can never sell the car or trade the car in because you get paid first. That's how you securitize it. I didn't mean to go long on that, but I love what N Carter 629 on TikTok said. Crypto is great with rules. Absolutely correct. Crypto is great if you trade it with rules. Thank you, man. That's a great comment. And then Marcus and Sachs said, you have to read the Messari. If you guys have never read this, it's the Messari, Messari report. I haven't looked at it in a long time, but it is a really neat report because it shows you which cryptos the hedge funds and they're holding. So what is big money holding? So if you really want to know, then look at the Messari. So some of these comments coming in now, these are great. These are useful.
Yeah, Chris, want to give a quick shout out to Noah Harris too. He runs a really cool meetup, real estate investment association group out of Columbia, South Carolina. And actually I'll be speaking at an event that they're doing on March 5th and 6th. If you want to check that out, it's reupmeetup.com, REUP meetup.com. And they do a really fantastic job of working with real estate investors and on the private lending side. So we'll be there talking about self-directed, how you can use retirement money to be able to do the stuff that Chris is talking about right now, securing yourself with first position and having these solid asset-based, assets as collateral. So, creating that passive income for yourself. So we'll be talking about, using retirement funds as well as privatized banking at his event, March 5th and 6th. So just wanted to give Noah a shout out and thanks for following along, Noah.
Yeah, thanks, Noah, man. Thanks for being here. And thank you for everybody for being here. But let me kind of interrupt this real quick with just a little announcement. For all of you that don't know, we do a free training every Wednesday at 1 p.m. Eastern time. You can go to chrisnaugle.com and you can register for it, where we're going to be really diving deep into awesome topics, and you get a free book. Okay, we email you this booklet. The booklet is Drifting Away from Traditional Car Buying. Okay, for all of you that are seeing this, free. Just register for the free webinar today at 1 p.m. and join us. We give some great knowledge, some great insight. There's no, sales pitch. It's not like, one of those seminars you come to where at the end you're like, all right, here it comes. No, none of that. We might talk about the experience, which is our mastermind. We've got, I think, 3 or 4 seats left at the next experience out at Sundance, Utah. If you're interested, you can also go to chrisnaugle.com and you can check out the experience. So these are all the things that we're doing. But most of the stuff that we do outside of our mastermind, okay, and outside of our 3-day training that we do, it's all free. So for all of you thinking, I love TikTok. They're always like, he's just trying to sell a book. Dude, my books are free. Like, you can just go on my website and get all my books for free, from Mapping Out the Millionaire Mystery to all of them. And we gave away some books today, The Richest Man in Babylon. So we gave, I think, 2 of those away. So I got to give 1 more away. But one last thing as we kind of close this out, Stephen, I want to talk about the Fed's doomsday prophet and the dire warning about where we're heading. So do you have that article you can pop up, or do you want me to?
Yeah, I can. And it might be one of those things we might have to tease it right now, because this is a good 45-minute discussion. I want to get in depth with it. So I think, so what we're seeing right now in the country is a lot of what's going on is being controlled and maintained, so to say, by the Fed. So the Fed does something called quantitative easing, where basically they pump trillions of dollars into the markets and allow, banks to borrow money at 0 interest rates, basically free flow of money. And they do this through controlling interest rates, through quantitative easing, and, through pumping all the money in. So we really want to, I think that looking into 2022 and 2023, I think a lot of what happens is going to be determined by what the Fed's decisions are. And they're coming out right now saying that they are planning on dropping quantitative easing, and they even want to get rid of it. And this article goes really well into why what we're seeing now with inflation skyrocketing and with the markets booming the way they are, a lot of that is caused by what the Fed has done over the last 10 to 12 years. Like Chris alluded to earlier with modern monetary theory and everything that the Fed is doing, it's created this artificial world that we live in right now that's driving the markets, whether it's real estate, whether it's stock, to all-time highs through their policy. And this stuff can't go on forever, because it causes things like inflation to go out of control. And what we're seeing right now in the economy, in the real economy, not the stock market, but in the real world, everyday people like you are seeing at the stores in higher prices and higher gas and everything that goes on. So this is a pretty important topic. So what I would like to do, Chris, is I think starting next week, just kick off 2022, is let's start getting into in depth, like we did today, with the history of investing, what that looked like. What's happening now, and what can you expect when the Fed makes these decisions, and how can you start positioning your money to not only protect it, but take advantage of what's happening? So this is the article I think we'll kick off with next week, and we'll go in depth with that. What does that sound like to you guys? Is that something that you think might help you?
Does that sound good, everybody? I mean, over here on TikTok and Instagram, do you guys want to learn more about, what the Fed's doomsday prophet is warning you about? We'll start that off, because I think it's really important. We're entering a new year. And with that new year, you're going to have New Year's resolutions, and you're also going to have to really start learning on what is the money you saved to you. Is it important? Is it a tool, or is it just a gamble? Like, we really have to set those rules in place. And if you really care about the money and the money means something to you, and your wealth means something to you and to your family, well, then you need to hear this next week. And we're going to go deep into that. And we're really going to spend the entire wealth webinar talking about it. We're going to bring all of you, this entire audience, into that huge. We're going to be watching comments very closely. I might even bring in a third person to kind of watch comments and really kind of just bring out the good questions that are being posted so that we don't miss them. Because, when we had TikTok running over 100 people today, I just couldn't keep up with the comments coming in. I was trying to do my best. So those of you that were on that I didn't get to your stuff, I apologize, but we try our best and we're going to do a better job. So with all of that, folks, just the knowledge is out there. Investopedia can tell you what all these different things are, but you just have to open your eyes and take the rosy-colored glasses off. And too many people are just caught into I don't even know what you're caught in. You're just bought into the investor confidence right now. The markets are just going to keep going up, and they are not. But you got to plan and prepare. And I think that's the biggest thing we try to do with this show. And the recap of the market, a week in review, is we're really just trying to show you what's happening, show you what the big lie is, show you what the wealthy do with money and how you can do the same darn thing. A lot of people are asking questions about, the infinite banking concept and privatized banking. Folks, just right in the bio, there's a link tree. Okay. There's a little link at the bottom. Just click that on TikTok. And once you click it on TikTok, there's the 90-minute video and there's the scheduling link. Once you watch the 90-minute video, schedule a call with us. We'll answer all the questions. People are asking, can they do it, with very little money? Well, that depends on what your needs and goals are. The answer simply would be yes, but it might not be a fit for you. It's not the silver bullet. It doesn't work for everybody, but it works for the right people that have the right goals and that are applying the laws of wealth. So we certainly can, help you, and you guys just got to check it out. But with that, Stephen, how do you want to close this out?
I love it, man. I'm excited for 2022. I think it's going to bring a lot of opportunities. I think it's going to bring a lot of success for people that are willing to open their minds and learn something new. Financial education is not taught in this country, and it's one of those things that I'm very passionate about. I can't wait to continue to share strategies like infinite banking, like privatized banking, like self-directed investing using retirement funds, like real estate investing, and taking advantage of when these markets do start to turn and correct and come down, how to start taking advantage of that and create massive success for you and your families into the future. And that's what it's all about. I truly believe over the next 12 to 18 to 24 months, more millionaires and billionaires will be created in this country than any other time in history. The only question is, are you going to be one of those? If so, we love following along with us. We'll keep pouring our hearts into sharing strategies that are working, that we're learning from our mentors, that we're learning from billionaires that coach us. We'll keep sharing it with you. And thank you for being here. I hope you guys have an awesome New Year's. Be safe there. We'll see you in 2022 next year.
And I got one. All right. If you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel, and don't ever forget to smash that alert button. We'll see you on the next one.